Precious metals markets are drawing close attention this weekend, as silver remains priced at $84.33 per ounce, the level at which Friday's Western trading session officially closed. That closing figure followed a notable intraday price movement on Friday, during which silver moved from $79 to $84.33 over the course of the afternoon session. Western commodities exchanges, including the COMEX, are closed for the weekend and are not scheduled to resume trading until Monday morning. The London Metal Exchange is similarly inactive during this period. As a result, no new paper contracts for silver can be issued through Western platforms until regular trading hours resume at the start of the new week. At the same time, the Shanghai Gold Exchange in China is scheduled to open on Sunday evening, Eastern Time. The Shanghai Gold Exchange operates on a physical delivery model, meaning that transactions conducted on that exchange require the delivery of physical metal to a vault located in China, rather than the settlement of paper contracts. That structural distinction between the Shanghai Exchange's physical delivery model and the paper contract system that characterizes Western exchanges is a point of particular relevance given current global supply chain conditions. On the energy and logistics front, the Strait of Hormuz, through which approximately 21 million barrels of oil flow daily under normal operating conditions, is reported to be closed to vessel traffic at this time. Dubai, identified in the source report as one of the largest precious metals trading hubs in the world, is reported to be experiencing disruptions to the movement of physical gold and silver bars between refineries, vaults, and dealers. The report specifically notes that metal currently held in Dubai warehouses is facing logistical obstacles in reaching destinations including London, New York, and Zurich. The gold-to-silver ratio is reported in the source material to currently stand above 90:1. The report notes that the historical average for that ratio is 15:1, representing a significant divergence from long-term norms. Annual silver mine production is cited at approximately 850 million ounces, with annual industrial demand reported at approximately 550 million ounces, leaving an estimated 300 million ounces available for investment demand on an annual basis. With Western markets closed, Asian exchanges preparing to open, and physical supply chain disruptions reported across key global logistics corridors, the coming trading sessions are being closely monitored by market participants and commodities observers worldwide. To understand the current dynamics playing out across global silver markets this weekend, it is first necessary to examine the fundamental structural differences between how silver is traded in Western markets compared to Eastern exchanges. Those differences, as outlined in the source report, are significant and directly relevant to the conditions currently being observed. Western precious metals markets, including the COMEX in New York and the London Bullion Market Association, operate primarily through a paper contract system. Under this model, market participants can buy and sell contracts representing silver without a requirement for physical metal to be delivered. Contracts can be written and traded without the underlying physical metal being present in a vault. This system allows for a volume of paper contracts to exist that exceeds the quantity of physical silver actually available for immediate delivery. The source report describes this as a fractional reserve model of bullion trading, in which the same physical ounce of silver can be represented by multiple paper claims simultaneously, a practice referred to in the report as rehypothecation. The Shanghai Gold Exchange, by contrast, operates on a physical delivery requirement. When a buyer purchases silver on the Shanghai Exchange, that transaction requires the actual physical metal to be delivered to a vault located in China. There is no mechanism on the Shanghai Exchange for creating synthetic silver supply through the issuance of unbacked paper contracts. The report describes this as a 1-to-1 model. 1 ounce purchased corresponds to 1 ounce delivered. As a consequence, the source report characterizes the Shanghai Gold Exchange as a physical price discovery mechanism that reflects actual supply and demand conditions rather than the dynamics of a paper contract market. This structural distinction becomes particularly relevant during periods when Western exchanges are closed. With the COMEX and the London Bullion Market Association both inactive over the weekend, the paper contract issuance mechanism that ordinarily operates in Western markets is entirely offline. The Shanghai Gold Exchange, scheduled to open on Sunday evening Eastern Time, will therefore represent the primary active price discovery venue for silver during the period before Western markets resume on Monday morning. The source report also addresses the physical supply chain conditions currently affecting the global bullion market. Dubai is identified as one of the world's largest precious metals trading hubs, serving as a key transit and distribution point for physical gold and silver, moving between refineries and major financial centers, including London, New York, and Zurich. The report states that current logistical disruptions in the region are affecting the movement of physical metal out of Dubai warehouses, with bars reported to be held in storage without viable transportation routes to Western vault destinations. The Strait of Hormuz closure is cited as the primary factor contributing to this logistical disruption. The source report draws on several historical episodes to provide context for the current market conditions. The first reference is to January of 1980, when silver reached $50 per ounce. The report attributes that price movement to concentrated physical buying and delivery demand that drained COMEX warehouse inventories and forced short position holders to cover their exposure. The report notes that $50 per ounce in 1980 is equivalent to over $200 per ounce in current terms when adjusted for inflation. The second historical reference is to the period between August of 2010 and April of 2011, during which silver moved from $18 per ounce to $49 per ounce, a gain of approximately 170% over 8 months. The report notes that this move occurred during a period described as one of relative calm, without the specific combination of geopolitical conflict, supply chain disruption, and logistics breakdown that characterizes the current environment. The third historical episode referenced is March of 2020, during which the paper silver price on the COMEX dropped to $11.75 per ounce. However, the report states that physical silver was simultaneously selling at dealer prices of $25 to $35 per ounce due to supply constraints caused by refinery shutdowns, mint closures, and frozen logistics networks. The resulting premium on physical metal over the paper spot price exceeded 100% during that period. Silver Eagles, the report notes, were selling for $38 per ounce when the spot price was $12, representing a premium of $26, or approximately 220% above spot. A fourth historical reference is made to the gold market dislocation of March 2020, during which COMEX gold traded at $1,590 per ounce, while physical dealers were selling coins at prices between $1,800 and $2,000 per ounce, a spread of approximately $400 between the paper price and the physical price. The report presents this episode as a precedent for paper and physical price divergence occurring during periods of market stress and supply chain disruption. The report additionally references the GameStop short squeeze of January 2021 and the Volkswagen short squeeze of 2008 as historical examples of gamma squeeze mechanics, a dynamic in which concentrated buying pressure at specific option strike prices creates a self-reinforcing feedback loop of hedging activity that accelerates upward price movement. The report identifies open interest in silver call options at the $85, $90, and $95 strike prices as a relevant factor in the current market structure. Turning now to the energy market developments that form a critical part of the broader context surrounding current precious metals conditions. The source report identifies the closure of the Strait of Hormuz as the primary geopolitical factor driving current market dynamics. Under normal operating conditions, approximately 21 million barrels of oil flow through the Strait of Hormuz daily. The report states that this flow has been interrupted, with the strait currently closed to vessel traffic. Brent crude oil is reported in the source material to be trading above $120 per barrel under current conditions. The report notes that price levels of $150, $175, and $200 per barrel are within the range of outcomes associated with an extended closure of the strait. The energy price environment has direct implications for the broader inflation picture, as outlined in the source report. When oil prices rise to elevated levels, the report notes, transportation costs increase, manufacturing costs increase, food prices increase, and the broader cost of living rises across multiple categories simultaneously. The report draws a distinction between official government inflation measurements, referencing the Consumer Price Index, and what it describes as real inflation, as experienced by consumers in categories including transportation, manufacturing inputs, and food. The report states that if oil reaches $200 per barrel, inflation across these categories moves to double-digit levels. The report also addresses the repo market as a relevant factor in the current financial environment. The repo market is described as the overnight lending mechanism through which banks borrow cash using treasury bonds as collateral, functioning as the foundational liquidity infrastructure of the broader financial system. The report states that repo market interest rates have been spiking, which it characterizes as a signal that banks are under cash flow pressure and are selling assets to raise liquidity. The report notes that this selling activity spans multiple asset classes, including stocks, bonds, commodities, and cryptocurrency. However, the report observes that silver has been behaving differently from other commodities in this environment, moving higher rather than lower alongside broader asset liquidation, which the report attributes to silver being purchased as a monetary hedge alongside its role as an industrial commodity. On the question of physical silver supply and demand fundamentals, the source report provides the following figures. Annual silver mine production is reported at approximately 850 million ounces. Annual industrial demand for silver is reported at approximately 550 million ounces. The remainder available for investment demand on an annual basis is therefore approximately 300 million ounces. The report frames this supply constraint in the context of potential demand scenarios, noting that a shift of even 1% of global wealth into physical silver would represent a volume of capital, measured in trillions of dollars, that significantly exceeds the value of the 300 million ounces of silver available for investment demand at current prices. Under those conditions, the report states, the price would need to rise substantially to ration available supply. The gold-to-silver ratio is reported at above 90-1 at current market prices. The report cites the historical average for this ratio as 15-1, indicating that silver is currently priced at a significant discount relative to gold compared to long-term historical norms. The report notes that at a 90-1 ratio, a given amount of capital purchases approximately 6 times more ounces of silver than it does gold. Regarding physical dealer premiums at the retail level, the source report references current premium levels at major online bullion dealers including APMEX, JM Bullion, SD Bullion, and Monument Metals. Premiums on Silver Eagle coins are reported to currently range from $8 to $12 over the spot price. The report draws a comparison to the March 2020 episode, during which Silver Eagle premiums reached $26 over a spot price of $12, representing a premium percentage of approximately 220% above spot. Applying a 50% premium to the current spot price of $84 would produce an all-in physical price of $126 per ounce. Applying a 25% premium to the current spot price would produce an all-in price of $105 per ounce. The source report also outlines the BRICS monetary framework as relevant context for current institutional demand patterns in precious metals. The report states that in 2024, the BRICS nations, identified as Russia, China, India, Brazil, and South Africa, announced the development of an alternative international payment settlement system to replace dollar-based transactions conducted through the SWIFT network. The report states that in 2025, this system went live, with Russia, China, India, Brazil, and South Africa beginning to settle international trade transactions in yuan, rubles, and rupees, with gold serving as a backing mechanism. The report states that under this system, oil trades, grain trades, and manufactured goods trades are being conducted without dollar intermediation and without participation by Western banking institutions. The report identifies several consequences of this development as they relate to current market conditions. United States Treasury yields are reported to be rising as foreign central banks reduce their purchases of United States government debt. The Federal Reserve is described in the report as facing a policy constraint in which raising interest rates is limited by the cost of servicing the existing national debt, which the report cites at $35 trillion, while simultaneously being unable to reduce rates due to prevailing inflation levels. The report characterizes this as a trapped policy position. On the question of the COMEX registered silver inventory and its relationship to outstanding paper claims, the report states that the leverage ratio between paper contracts and registered physical silver available for delivery currently stands at approximately 7 paper ounces for every 1 registered physical ounce. The report draws a parallel to the gold market of the 1970s, during which the official United States government gold price was fixed at $35 per ounce, while free market transactions reflected prices of $100, $200, $500, and eventually $800 per ounce. The report notes that the official price was ultimately abandoned as the divergence between the fixed price and free market valuations became too large to sustain. As this weekend broadcast draws to a close, it is appropriate to bring together the full scope of developments reported across precious metals markets, physical supply chains, energy markets, monetary conditions, and institutional demand patterns into a single consolidated summary. On the silver market specifically, the closing price recorded on Western exchanges this Friday was $84.33 per ounce on the COMEX. That figure followed an intraday move during Friday's session, in which silver rose from $79 to $84.33 over the course of the afternoon. Western exchanges, including the COMEX and the London Bullion Market Association, are closed for the weekend and will not resume operations until Monday morning. The Shanghai Gold Exchange is scheduled to open on Sunday evening, Eastern Time, and will represent the primary active price discovery venue for silver during the period before Western markets resume. As previously outlined, the Shanghai Gold Exchange operates on a physical delivery model, requiring one-to-one correspondence between purchased contracts and delivered metal, in contrast to the paper contract system that characterizes Western exchanges. The COMEX leverage ratio between outstanding paper silver contracts and registered physical silver available for immediate delivery is reported at approximately 7 paper ounces for every 1 registered physical ounce. That figure represents the gap between total paper claims on silver within the Western futures system and the physical metal inventory actually available to satisfy delivery requests. The report identifies this ratio as a structural vulnerability within the current paper market framework, drawing a parallel to the 1970s gold market, in which an official fixed price became unsustainable as the divergence between paper valuations and free market physical demand widened beyond the point of enforcement. On the physical supply chain front, Dubai, identified as one of the world's largest precious metals trading hubs, is reported to be experiencing logistical disruptions affecting the movement of physical gold and silver bars to Western vault destinations including London, New York, and Zurich. The Strait of Hormuz, through which approximately 21 million barrels of oil flow daily under normal conditions, is reported to be closed to vessel traffic. Brent crude oil is reported above $120 per barrel under current market conditions. Qatar has declared force majeure on liquefied natural gas exports following the shutdown of the Ras Laffan facility, with a recovery timeline of a month or more reported. European gas prices are reported to be up over 50%, with the United States supplying more than half of Europe's liquefied natural gas under current conditions. On the retail physical silver market, premiums at major online bullion dealers including APMEX, JM Bullion, SD Bullion, and Monument Metals are currently reported at $8 to $12 over the spot price for Silver Eagle coins. The report draws comparison to the March 2020 episode, during which Silver Eagle premiums reached $26 over a spot price of $12, representing a premium of approximately 220% above spot. The report notes that applying a 50% premium to the current $84 spot price would produce an all-in physical cost of $126 per ounce, while a 25% premium would produce an all-in cost of $105 per ounce. On the supply and demand fundamentals, annual silver mine production is reported at approximately 850 million ounces. Annual industrial demand is reported at approximately 550 million ounces, leaving approximately 300 million ounces available for investment demand annually. The gold-to-silver ratio stands above 90 to 1, against a reported historical average of 15 to 1. Annual silver mine production figures, COMEX inventory reports, and the commitment of traders data are all publicly available documents that the report directs readers toward for independent verification of the figures presented. On the monetary and institutional context, the BRICS trade settlement system involving Russia, China, India, Brazil, and South Africa is reported to have gone live in 2025, settling international trade in member nation currencies, with gold serving as a backing mechanism. United States Treasury yields are reported to be rising as foreign central bank participation in United States debt markets declines. The Federal Reserve's policy position is described as constrained on both sides, limited in its ability to raise rates by the cost of servicing $35 trillion in national debt, and simultaneously limited in its ability to reduce rates by prevailing inflation conditions. Historical precedents cited in the source report include the January 1980 silver price peak of $50 per ounce, the 2010 to 2011 silver rally from $18 to $49 per ounce, representing a gain of approximately 170% over 8 months, the March 2020 paper-to-physical price dislocation in both gold and silver markets, the GameStop short squeeze of January 2021, and the Volkswagen short squeeze of 2008, each presented as documented examples of the market dynamics described in the report's analysis of current silver market structure. For those monitoring market developments as the weekend continues, the Shanghai Gold Exchange opening on Sunday evening Eastern Time represents the first major price discovery event before Western markets resume on Monday morning. COMEX registered inventory levels, updated daily and publicly accessible, will provide ongoing data on the physical drawdown trend. The Commitment of Traders report, published weekly as a public document, remains available for independent verification of futures market positioning. Retail dealer premium levels at major online bullion platforms will serve as a real-time indicator of physical supply availability at the consumer level. This has been a comprehensive weekend market briefing covering silver market structure, Eastern and Western exchange dynamics, physical supply chain conditions, energy market developments, retail premium data, monetary policy context, and the institutional demand patterns shaping the global precious metals landscape as of Saturday, the 7th of March, 2026. All figures and developments reported are drawn exclusively from the original source material. Individuals are encouraged to verify all data points through the publicly available sources identified in this broadcast, and to consult qualified financial professionals before making any decisions related to commodity markets or investment portfolios. We will continue to monitor all relevant developments as they emerge ahead of Monday's market open. Thank you for watching.